Welcome to Quant Solutions. Ever wondered why some investments just feel riskier than others and how that translates into what you might actually earn? Today, we're embarking on a deep dive into a true cornerstone of modern finance, William F. Sharpe's 1964 paper, Capital Asset Prices, a theory of market equilibrium under conditions of risk. Our mission. We're going to try and crack open the capital asset pricing model, CAPM, and show you exactly how this foundational idea helps you, the everyday investor, truly get a handle on risk and return in your portfolio.
It's a fascinating topic. And, before Sharpe's work, finance theory was really grappling with a big puzzle. It was a bit like, trying to figure out why some assets offered higher returns. We sort of knew a risk premium existed.
Right, you get paid more for taking more risk. Seems obvious.
Exactly. But why? And how much more? There wasn't a clear, elegant way to explain it. It was often just asserted. Sharpe's CAPM offered this really powerful answer. Not all risk is priced equally. That's the key. The core idea is that in competitive markets, investors are primarily compensated for what we call systematic risk.
Okay, systematic risk. What is that exactly?
Think of it as market risk, or beta. It's the kind of risk tied to the whole economy, like, recessions or booms, things you can't really avoid just by picking different stocks.
That affects everything.
Pretty much. And you simply cannot diversify it away completely. Now, on the flip side, there's idiosyncratic risk.
Idiosyncratic, meaning unique.
Exactly. Risk that's specific to one company or asset, like maybe a bad earnings report for one specific firm, or a factory fire. The market, kind of surprisingly, doesn't really pay you extra for that kind of risk.
Wait, why not? If I buy a risky startup, I'm definitely taking on its specific risk.
But the theory says you could have spread your money across many different assets, diversified. If you do that, those company-specific ups and downs, they tend to cancel each other out, more or less. So the market only compensates you for the risk you can't get rid of through diversification. That's the systematic part.
Okay, that makes sense. So this beta thing you mentioned, what exactly is beta and why should everyday investors care about it?
Right, beta. It's crucial. Beta measures how much an asset's expected return tends to move with the overall market. So if an asset has a high beta, let's say 1.5, it means if the market goes up 10%, that asset might, on average, go up 15%.
More volatile then.
More sensitive to market swings, exactly, and vice versa if the market falls. If beta is less than 1, it's less sensitive. Diversification is key because it lets you shed that company-specific idiosyncratic risk. What's left is the systematic risk, the beta, and that's what the market actually rewards you for taking on.
Okay, let's unpack this. If idiosyncratic risk isn't priced, what's the ideal way to build a portfolio, according to CAPM?
Well, the theory points towards something called the market portfolio. It suggests that the market-valuated portfolio of all risky assets is mean variance efficient.
Mean variance efficient. Sounds technical.
It just means it gives you the best possible return for a given level of risk, or the lowest risk for a target return. It's the optimal blend. So ideally, investors should basically hold this market portfolio, own a tiny piece of everything risky out there.
Like a global index fund, maybe.
That's a practical way to think about approximating it, yes.
Yeah.
And then you adjust your overall risk. Want less risk? Hold more cash or risk-free assets alongside the market portfolio. Want more risk? You could potentially use leverage. But the core idea is, first, get the optimal risky mix, then dial your overall risk up or down.
That's quite a powerful idea. Less focus on picking winners, more on the overall market exposure. So
Sure.
What does this mean practically for, someone managing their own money?
CPM has some really solid practical uses. First, valuation. It helps estimate the required return for an investment. Based on its beta, you can figure out the return investors should demand. So don't just look at how much it bounces around day to day. Focus on its beta.
Okay.
A portfolio construction. It provides strong theoretical backing for index funds or passive strategies. They try to mimic that efficient market portfolio. And third, performance evaluation. Concepts like alpha, specifically Jensen's alpha, come straight from CAPM.
Alpha. That's like beating the market, right?
Yeah, kind of. It's the return after accounting for the risk taken, measured by beta. Positive alpha suggests maybe the manager has skill or the asset was genuinely mispriced. It's the excess return you didn't expect based on market risk alone.
This model sounds incredibly neat, almost elegant. But I have to ask, is it the whole story? The real world usually has some wrinkles.
You're absolutely right. While CPM was truly groundbreaking and removes foundational, it has faced challenges when tested against real-world data. Things like transaction costs, taxes, the fact that maybe you can't borrow easily at the risk-free rate, those complicate the picture.
And haven't researchers found other factors that seem to matter besides beta?
Exactly. They found anomalies. Like the size effect, smaller companies sometimes outperformed what CPM predicted. And the value effect stocks that looked cheap based on fundamentals often did better too. This suggested beta alone might not capture all the dimensions of risk that get priced, which led to, more complex multi-factor models later on.
So an important first step, but maybe not the final word.
Precisely. But APM's core insight, distinguishing between systematic risk that gets rewarded and idiosyncratic risk that remains absolutely essential. It changed how everyone thinks about risk.
This deep dive really highlights that understanding systematic risk measured by beta is just crucial. It's not merely about how volatile an asset is on its own, but how it moves with the entire market. That seems to be the key takeaway.
And that really brings up an important question for you, the listener. Knowing that, theoretically, only the systematic risk is compensated. How might that understanding shift your perspective on the investments you choose? How might it change how you think about their riskiness in your own portfolio?
Something to definitely ponder as you continue your investment journey.